90% silver premiums collapsing is an T bearish. That ideas the market admitting the paper price and the physical pipeline are no longer moving in the same rhythm, and a lot of people who only stare at the spot chart are about to get blindsided by the spread. Because the conflict right now is simple and ugly, the headline tape is screaming, silver broke out, while the real-world plumbing is whispering, liquidity is changing hands under stress. And if you know where to look, you can tell whether this is a healthy repricing or the kind of move that turns into a vacuum candle when the wrong side realizes they can T-source metal fast enough. Stay with me because I'm going to give you the one hidden detail that reframes why 90% premiums vanish, what it forces dealers and hedgers to do, and the exact checklist for the next week or two, what level matters, what confirms, and what would punch a hole through the whole thesis. And here is the uncomfortable truth up front. The price can whip you around violently even if you were right, and that's not a bug, it's the business model of volatility. But that's not the part that matters. The part that matters is the spread, the physical spread, the what can I buy at versus what can I sell at spread. The will a dealer actually bid for size right now, or will they smile and widen you out spread? Because when the market is calm, premiums behave like a simple retail tax. Availability tightens, premiums rise. Availability loosens, premiums fall. Nice and clean. But in a regime change, when silver is sprinting, not jogging, premium logic stops being about demand and starts being about survival. And that's where the real pressure starts. Look at the price context we just lived through. This wasn't a gentle grind. In January alone, silver went from the low 70s to the 90s and then into triple digits in a matter of weeks. That kind of move doesn't just raise silver. It detonates risk models. It flips financing math. It changes how fast inventory can be replenished. And it forces everyone in the chain, wholesalers, refiners, coin shops, online dealers, even the big hedgers sitting behind the curtain, to make the same choice. Do I keep quoting tight markets and risk getting run over? Or do I protect my balance sheet by changing the spread? And when you see 90% premiums vanishing, what you're watching is that choice being made in real time. Now, let's get precise about what 90% is, because if you don't understand the object, you'll misread the signal. 90% silver is the old US coinage, dimes, quarters, halves from the constitutional era, sold by face value, not by ounce count on the label, even though everyone in the business knows the rough conversion. It's fractional, it's messy, it's heterogeneous. It's not a neat row of brand new 999 bars with serial numbers and perfect edges, and that matters because in a stressed market, the world pays up for what is easy to hedge, easy to deliver, and easy to finance. 90% is loved by retail because it's divisible and familiar, and in fear waves it can get stupid expensive because people want something I can hold in small pieces. But here's the pivot. 90% is also a supply chain product, not a museum artifact. Most of it ultimately wants to become refined silver again, melted, processed, turned into 999 grain, bars, rounds, industrial feedstock, whatever the system demands. That conversion process is the bridge between junk silver and the broader silver complex. And the hidden detail, this is the thing most people miss, is that the bridge can jam. When it jams, premiums don't always rise like people expect. They can collapse because the market is telling you this item is not the bottleneck right now. The bottleneck is turning it into the form the system can actually use. Think of it like crude oil versus gasoline during a refinery outage. You can have plenty of crude sloshing around and still have a gasoline shortage. The crude price doesn't necessarily explode the way the pump price does because the constraint is the processing capacity. Same idea here. 90% is feedstock. Refining capacity is the choke point. And in a fast-rising silver market, that choke point becomes a financial choke point. Because refineries don't just take metal out of kindness. They take it when their throughput, labor, and hedging lines are stable, and when the financing math works. In a calm regime, a refinery can take in scrap junk, hedge exposure, process, and sell output into a market with predictable spreads. In a violent regime, everything about that cycle becomes risky. The hedge can gap the cost of carry spikes. The bid for input metal becomes a moving target, and suddenly the refinery either slows intake or demands a bigger margin of safety. If intake slows, dealers holding piles of 90% don't have a smooth exit valve. And when the exit valve narrows, what happens to the bid? It drops. Not because nobody wants silver, because nobody wants to be the one holding the wrong form of silver when the music pauses. And that is how you get the weirdest tape of all. Spot silver ripping higher while some segments of physical, especially messy, fractional, scrap-like segments, see premiums compress and buyback bids get stingy. That's the part that flips the whole setup. Now, before anyone turns this into a cartoon villain story, don't. You don't need manipulation to explain it. You just need incentives, risk limits, and market structure. Dealers are not charities. They're market makers with a storefront. And when volatility spikes, their main job is not to help you get a good deal. Their job is to not die. They widen spreads. They change what they stock. They shift from sell as much as possible to manage inventory duration. And in a fast market, duration is lethal. If silver is moving $5, $7, $10 in a blink, holding inventory is like holding a short option. Your risk balloons the wrong way. So they do what any rational market maker does. They quote in a way that makes sure they can survive being wrong for a day. And that shows up as premiums that don't behave intuitively. Here is how it presents on the street. Retail ask prices can remain sticky because nobody wants to be the first dealer to slash the front-end price and get a flood of orders they can T-replace. But the back end, the buyback, the bid I'll pay you for your 90%, can fall faster than you think. The spread expands or shifts, and that spread is the truth serum. Because if a market is genuinely tight in a way that matters, bids get aggressive. They compete. They call you. They pay up to pull metal in. If bids get soft while spot is strong, that's a sign the system is managing a different kind of stress. Processing constraints, financing constraints, or hedging constraints. Everyone's watching the headline, but the signal is somewhere else. Now, layer in the bigger market structure, because this is where retail gets confused and institutions get paid. Paper silver, futures, swaps, options can reprice instantly. Physical silver cannot. Physical has lead times, logistics, fabrication capacity, and form constraints. A futures contract is a price. Physical is a product, and the bridge between the two is delivery and arbitrage. In a normal world, if paper runs too far ahead, arbitrage brings it back. Physical moves toward where it's priced higher. Hedgers lock spreads and inventories shift. In a stressed world, arbitrage doesn't disappear. It becomes expensive. It requires balance sheet. It requires storage. It requires confidence that you can source deliverable metal in the right form at the right time. And when confidence cracks, you see it in the term structure, the relationship between near-month and forward prices, and in the local spreads across products. If the nearby market starts behaving like metal now is worth more than metal later, that's a flashing light. It's not trivia. It's the market pricing immediacy. It's the market pricing scarcity of deliverable supply or the cost of getting through the pipe. But, and this is critical, sometimes you can see nearby tightness in paper, while certain retail premiums soften, because those are different bottlenecks. Comic-style deliverability is about specific forms and specific locations and a specific deliverable category. Retail 90% is a different animal. When people scream paper versus physical, they often miss that physical. Itself is not one thing. It's multiple micro-markets stitched together by refining, fabrication, and distribution. And the stitches are exactly what tear during volatility. But that's not the part that matters. The part that matters is what this forces participants to do this week. Because this week has a calendar loaded with pressure points. You've got a Federal Reserve meeting on the calendar, policy decision midweek. And whether the Fed moves or not, the narrative risk alone can swing real yields, the dollar, and risk appetite, which swing metals, which swing volatility, which swings dealer behavior. You've got month-end positioning behavior, where funds that live and die by statements and benchmarks don't want to look stupid on the last print. You've got options dynamics, gamma and dealer hedging, where the market can mechanically create buying or selling as strikes get approached. And you've got thin liquidity moments around holidays and overnight sessions, where price can gap into air pockets. Put those together, and you get a setup where the next 1 to 2 weeks can be defined by forced behavior, not opinions. Now that's the big tell. Opinions are cheap. Forced behavior moves markets. So let's talk about at least one mechanism cleanly, because you deserve the how, not vibes. Here, SO simple way to understand options, reflexivity in a metal ripping higher. When a lot of calls are bought and the price approaches popular strikes. Dealers who sold those calls may hedge by buying the underlying or futures to remain neutral. If the market is in a positive gamma pocket, dealer hedging can dampen moves. If it's in a negative gamma pocket, hedging can amplify moves, because they have to buy as it goes up and sell as it goes down. In a fast breakout, you can get that nasty reflexive loop. Price rises, hedgers buy, which pushes price further, which forces more hedging. That's not conspiracy, that's plumbing. And even if you never touch an option in your life, it matters because it can create the kind of upside continuation that makes retail chase at the worst moment, right before a brutal pullback that makes them puke. Because volatility loves to do one thing, it punishes certainty. And the next detail is what flips the whole setup. When you combine options-driven chasing with a constrained physical pipeline, you can get a strange divergence. Paper price accelerates while certain physical products show premium compression as dealers ration risk and refineries bottleneck. That divergence doesn't mean the rally is fake. It means the market is repricing in layers. Institutions chase what they can scale and hedge. Retail fights over what they can touch. Dealers protect their spread. Refiners protect their throughput. And somewhere in the middle, the physical spread becomes your early warning system. If you want proof, real proof, not one argument, you need a stack. So here's the stack, and I want you to listen for the mechanism in each layer. Layer 1, chart structure. When silver doesn't just break a level, but holds above it, retests it, and then uses it as a launch pad, that's a structural change in who is trapped. A clean break above major psychological zones, think 90, 95, 100, changes the behavior of shorts because margin requirements and risk limits aren't linear. The higher you go, the more optional a short becomes for the risk manager. They don't ask, do you believe? Or they ask, can you survive a gap? Layer 2, term structure and immediacy. If the market starts valuing near-term delivery more aggressively, it's signaling stress in obtaining metal on time or stress in financing inventory. Layer 3, institutional flow behavior. Big money doesn't rush into bags of dimes, it rushes into vehicles and contracts that can be custody cleared, sized, and hedged. When those channels turn on, the spot price can move even if some retail segments are doing something else. Layer 4, supply chain reality. Silver is not a tap you turn on. Much of it is byproduct from base metal mining, which means supply response is sluggish, and refining capacity and fabrication capacity are real constraints with real lead times. Layer 5, street level symptoms. If you hear 90% premiums are vanishing, that's a street symptom. It's not a global supply statistic. It's a micro market signal that tells you something about inventory duration, buyback risk, and conversion friction. Layer 6, because we're not stopping at 5, cross-market comparison. When gold is ripping and silver is outrunning it, the gold-silver relationship itself becomes a positioning battlefield. If silver is leading, it often means the market is reaching for convexity and volatility, because silver is the higher beta cousin. And when the market reaches for volatility, it also sets the stage for volatility to bite back. Proof isn't one number. Proof is behavior across layers. But that's not the part that matters. The part that matters is what you do with it. So let's translate the technical into so what? If 90% premiums are vanishing, your first question is not, is demand gone? Your first question is the bid collapsing, the ask collapsing, or both? Because those are different stories. If asks drop but bids remain firm, that can be simple normalization, dealers finally getting supply and competing for your business. If bids drop while asks remain sticky, that excess dealer risk management, protecting themselves from being long a product they can efficiently turn or hedge. If both drop, that's either genuine cooling demand or a temporary reset after a blow-off. The spread tells you which it is. And here's the hidden detail again, in plain language. 90% is not instantly usable for the market's largest settlement and hedging channels, and the ability to convert it depends on refinery throughput and financing conditions. When those tighten, the spread can lie to you if you only look at the sticker price. You need the buyback, you need the wholesale bid, you need the speed of replenishment. And because you probably don't have a refinery in your garage, you use proxies. Are dealers paying up for 90% again? Or are they not really buying unless it's cheap? Are online dealers showing deep inventory? Or are they pushing pre-orders and longer ship times? Are spreads on common products tightening or widening? Those are the footprints of stress. Now, let's address the skeptical counterpoint, because credibility lives there. The skeptic says, premiums falling just means the panic buyers are done. It's bearish. Well, sometimes that is true. Retail demand is cyclical. It surges, it fades, it comes back. If silver goes vertical and then chops, the last buyers are often exhausted. Premiums can compress simply because the wave passed. You respect that. You don't hand wave it. But here's the rebuttal mechanics. In a true demand collapse, you typically see price itself lose structure, not just premiums. You see spot roll over, fail key levels, and you see bids soften across the board, not just in the messy segments. In a pipeline stress regime, you can see spot remain strong or even stronger, while certain premiums compress for form-specific reasons. That distinction matters this week because if this is pipeline and hedging stress, the next move can be sharper than people expect, either as a continuation squeeze when the right form goes tight, or as a controlled pullback when the market needs to cool the hedging loop and rebuild liquidity. And that's why we need the two-scenario lens. Scenario 1 is the controlled pullback and retest. In that scenario, silver cools off from triple digits, pulls back toward a prior breakout zone, think the mid to high 90s, maybe the low 90s if volatility gets spicy, then stabilizes. You want to see the market hold structure, higher lows, buyers defending dips, and most importantly, you want to see the physical spread stop deteriorating. Maybe 90% premiums don't explode, but buyback bids firm. The spread tightens. That tells you liquidity is returning and the pipeline is unclogging enough to support the new level. Scenario 2 is the continuation squeeze. In that scenario, silver doesn't give you the polite retest. It gaps, it runs, and liquidity thins. Dealers get nervous, shorts get forced. Options hedging turns into a buyer. In that world, you can see certain physical products go from premium vanishing to premium snapping back very fast, but it won't be uniform. The market will pay up for what is immediately deliverable, hedgeable, and widely accepted, while other segments stay weird. That's the key. A squeeze doesn't mean every product premium rises together. It means the bottleneck product gets bid, and if that happens, the math changes. Because if you're watching only 90% premiums, you might think nothing is happening right before the deliverable channel tightens and spot accelerates again. So what do we watch next, concretely, in the next week or two? You watch levels and you watch behavior around them. The big psychological line is 100. Not because it's magic, but because it's where narratives cluster and risk limits get tripped. Above 100, the market is in headline land. Below 100, the market tries to prove whether the breakout was real. Then you watch the prior acceleration zones, roughly the mid-90s and around 90, because those are the areas where late shorts often initiated and where early longs often add. If silver breaks back below 95 and can't reclaim it, the market is telling you momentum is cooling. If it breaks below 90 and stays there, that as a bigger warning that the blow-off phase may be unwinding and the premium vanishing could be demand fade, not pipeline stress. That would be a clean invalidation line for the hot bull case, a sustained loss of the last major breakout zone and failure to snap back quickly. On the upside, if the market holds above the high 90s on pullbacks and keeps printing higher highs, you assume the trend is intact, but you don't assume it will be smooth. You respect the whip, because price can whip around violently even if the thesis is correct, especially around Fed week, month-end, and big options windows. And that's not fear-mongering. That's the nature of leveraged markets meeting thin liquidity. But that's not the part that matters. The part that matters is confirmation through the spread. Here, as a simple confirmation checklist that would at T require you to be a quant with a Bloomberg terminal. 1. Does the buyback bid for 90% stop sliding? If dealers start paying up again even modestly, that's a signal the pipe is clearing, or that they're comfortable holding inventory again. 2. Do common. 999 products, like standard bars and rounds, show tighter spreads even as spot moves. Tight spreads in a volatile market are a sign of confidence. Wide spreads are a sign of fear. 3. Do delivery-sensitive signals, like near-term pricing versus later pricing, suggest urgency? You don't need the exact curve. You need to notice whether the market feels like it's paying for immediacy. 4. Do you see signs of forced behavior, sudden vertical moves, overnight gaps, sharp reversals near round strikes that hint options hedging and margin pressure are dominating? 5. Do you see the macro tape supporting metals, real yields, currency stress, policy uncertainty, or does it flip risk on in a way that could temporarily drain safe haven flows? You stack these. You don't marry one. And you always keep the counterpoint on the table. Premiums can compress because the panic wave cooled. So the question becomes, is price structure holding while spreads normalize, or is price structure breaking while spreads collapse? Different outcomes, different risks. Now, I want to give you one more layer of proof that S quietly powerful. The supply-demand balance story. Industry surveys have been flagging multi-year deficits and record industrial demand. Think hundreds of millions of ounces of industrial pull with deficits on the order of 100+ million ounces in some recent years. Whether you believe every digit or not, the direction matters. Industrial usage is not a meme, and mine supply is not infinitely elastic, especially when a meaningful portion of supply is byproduct. That SY silver can behave like an industrial metal in slow times and like a monetary metal with a jet engine in stressed times. And right now it's trying to be both at once. That dual identity is exactly why spreads and bottlenecks matter so much. Industrial buyers care about reliable supply in specific forms. Monetary buyers care about ownership and custody. Institutions care about instruments and hedges. The market has to satisfy all three, and it can't do it seamlessly in a vertical move. So it rations through spreads. It rations through lead times. It rations through who gets tight pricing and who gets widened out. And if you're watching 90% premiums vanish, you're watching one corner of the rationing system change its rules. Because if the pipe can't instantly turn 90% into what the broader market needs, 90% becomes less special in that moment, even if silver itself is more special. That sentence sounds like a paradox until you realize the market is not one market, it's a network, and networks fail at the edges first. Now let's talk about the psychological game, because this is where most people lose money while being right on the big picture. Volatility doesn't just move price, it moves your decision points. It makes you chase strength and fear weakness. It makes you need to act right when spreads are widest and liquidity is thinnest. And the market loves to manufacture emotional certainty with 2 tricks. Trick 1, the victory lap candle. A huge green move that feels like confirmation and convinces late buyers to pay any price. Trick 2, the betrayal candle. A sudden smash that feels like it is over and convinces weak hands to dump into the bid that professionals were waiting with. If you want a simple shield, you stop treating every tick as truth. You separate trend signal from noise. Trend signal is structure. Higher highs and higher lows, key levels holding, spreads behaving in a way that suggests real demand or real tightness. Noise is the violent intraday whip around news and option strikes. You can respect both without being controlled by either. And here, as a practical behavioral rule, if you find yourself making a decision because you feel rushed, that's usually the market's trap. Slow down. Zoom out. Ask what the spread is doing. Ask what level actually matters. Ask what would invalidate the thesis. If you can't answer the invalidation question, you're not trading a thesis, you're trading adrenaline, and adrenaline is expensive. But that's not the part that matters. The part that matters is the near-term roadmap. So here it is, tight and concrete, without pretending anyone can predict every candle. Over the next 1 to 2 weeks, watch how silver behaves around 100 and the high 90s. If silver holds the high 90s on pullbacks in the physical spread firms, especially buyback bids stabilizing, that's a strong confirmation that this is not just retail heat, it's a broader repricing with real support. If silver spikes above 100 again and you see signs of forced behavior, gaps, vertical stretches, chaotic reversals, assume option hedging and margin dynamics are in the driver's seat and treat it like a market that can overshoot and punish complacency. If silver loses the low to mid-90s and can't reclaim it, and simultaneously premiums and bids sag across physical, you shift your bias toward a cooling phase where the market needs time to rebuild liquidity. And if silver breaks below 90 and stays there, that is the hard warning that the breakout phase is failing and the premium vanishing story could be simple demand exhaustion. That's your invalidation level zone, not because 90 is holy, but because it's where the market last proved it had a new floor. Lose the floor and you stop assuming the ceiling is next. Now, on the physical side, stop obsessing over the posted retail premium alone. Watch the spread as a behavior report. If 90% premiums are vanishing because dealers are discounting to move inventory but still paying up on buybacks, that's healthy normalization. If premiums are vanishing because dealers are widening buybacks, paying you less, hesitating to take size, that's risk management and pipeline friction. That doesn't automatically mean bearish. It means the market is under stress in the conversion channel. And in a stressed system, the next move can be violent in either direction. That's why you hold 2 scenarios in your head at all times. Controlled retest versus continuation squeeze. Controlled retest rewards patience and level discipline. Continuation squeeze rewards being early, not being loud. And if you're late, your edge is not heroism, your edge is process. One more thing, because it matters more than people think. Month-end and Fed week narratives are not just news. They are liquidity events. When policymakers speak, when rates expectations shift, when risk assets wobble, liquidity providers change their posture. In metals, that posture change is visible in spread, in overnight gaps, and in how quickly dips are bought. So don't just watch price during the announcement. Watch price in the hours after, when the market reveals whether it actually believes the move. Because the first move is often the trap, the second move is the message, and if you want to build trust with yourself as an investor, you stop trying to win every minute and start trying to read the regime. Right now the regime is big move, high volatility, market structure pressure, physical network adjusting. In that regime, patience is not passive. It's a strategy. You let the market show its hand at key levels. You watch the spread like a heartbeat monitor. You respect that the price can whip you even if you're right. And you don't confuse a temporarily vanishing premium with a permanently vanishing thesis. Because premiums are symptoms. Structure is the disease. The final takeaway is simple. Don't worship spot. Watch the physical spread, the calendar, and the forced behavior signals. Watch 100 as the headline line, watch the high 90s as the does the breakout hold zone, and watch 90 as the does the story break zone. Watch buyback bids on 90% to see if liquidity is returning or if the conversion pipe is still jammed. Watch for the market as emotional tricks and refuse to make rushed decisions at the worst possible moment. And if you are the kind of person who wants the truth even when it's uncomfortable, this is exactly the moment to build your edge. Not by predicting, but by tracking what forces participants to do next. If you're still here, you're already in the minority that doesn't need the hype. You need the mechanism. Stick with that crowd, share what you're seeing in the spread, and keep your process tight. Because in this regime, the market doesn't reward the loudest voice. It rewards the calmest execution.